On to markets news now. Asian shares saw a mixed performance at the close of the week. This after a negative performance on Wall Street. One of the drivers behind the more negative sentiment are concerns that harder moves by central banks on higher interest rates could result in a global recession. Japanese stocks were hard hit on the day, dragged down in part by the SoftBank Group, which plunged by over 4%. The Nikkei share average declining by 1.77%. Hong Kong shares actually recovered from earlier losses, with the Hang Seng Index managing to close up 1.1%. Mainland China stocks also ended the week higher, with the Shanghai Composite Index closing 0.96%. Let's just call it 1% in the black. Over in the United States, U.S. stocks came under strain, falling sharply overnight. This was a reversal of the buoyant reaction of stocks on Wednesday evening to the Fed's decision to raise rates by 0.75 percentage point. With the dust having settled, players now realize that they're operating under very uncertain times, with continued concerns around the possibility of stagflation. The Dow Jones Industrial Average fell by 2.42%. The S&P 500 declined by a whopping 3.25%, while the tech-heavy Nasdaq tumbled by over 4%. Let's take a look at the indicators. Well, to give us a breakdown of what's happening on the markets, I'm joined by Viv Govender. He's a portfolio manager at Rand Swiss. Thanks very much, Viv, for talking to us today. The market has been crying out for central banks to be more credible and address higher inflation. But when they do, the markets still sell off anyway. So what's going on exactly?
Well, you must understand that the way the central bank controls inflation is by beating the economy down so it doesn't grow as much, and basically more people become unemployed. That is literally the mechanism they use. We use all these terms about setting inflation expectations, blah blah blah. But the way in which the central bank actually controls inflation is by raising interest rates. Raising interest rates makes economic activity more difficult, causes the growth to slow down, causes unemployment to go up, and those actually result in higher, also less demand coming through, which actually effectively controls inflation. So we have to have these negative effects with high interest rates. There is no side effect that is high interest rates, by the side effect causes these downturns.
Yeah. So what did the European Central Bank say about its urgent meeting that surprised the markets and created jitters? What was the final resolution from them?
Well, the European Union has a problem that it's had for quite some time. We saw it in 2008. It's basically the southern states, places like Greece and Italy and so on, have had real difficulties regarding keeping their bond rates at reasonable levels. Why? Because they just don't spend as judiciously as the northern states do. So places like Germany, for instance, have kept their budget really under control. They don't overspend, and therefore the market rewards their bonds with very low rates. Places like Italy, places like Greece don't do that as well, and therefore the market results in punishes them in a certain extent by requiring a high interest rate for their bonds. The ECB's aim was to get into the market and try and control some of this differential and try and help some of the southern states basically in these tough times. Unfortunately, they had to basically go against some very tough laws, because when the euro was created, there was an agreement among all members that came in that they would follow certain fiscal rules, and unfortunately the southern states are not doing that at the moment.
Yeah. Help us understand a little bit. In the United States, interest rates went up by 75 basis points in an environment where they have inflation of 8.6%. In the United Kingdom, they have inflation of 9%, and yet they only increased interest rates by 0.25%. What's the science there, if there's any?
To a certain extent, these central banks really are not the experts that we hoped they would be. I mean, if you had to go back 2 weeks ago, or a week and a half ago, and look at consensus around what the central bank would be doing in the US, it was 0.5%. This 0.75 came out because of an inflation number that only occurred at the end of last week. very few people have a true understanding what's really going to happen with regards to, whether there's going to be a hard landing or soft landing. The central banks did not even know inflation was permanent or transitory until very recently. And some argue they still don't know if it's transitory or permanent or not. So they're doing the best they can. Unfortunately, what we've seen in the past is there is a bit of discrepancy. But generally what you tend to find is that the US is more aggressive. They're more aggressive when they cut interest rates after the 2008 financial crisis, and they're more aggressive now when they're raising it to fight inflation. Whether or not that turns out to be the right decision remains to be seen. But it's not just the Bank of England, the Bank of Japan, the ECB have all been much, much less aggressive when it comes to fighting inflation than the US is, even though, like you said, they probably have some higher inflation fears in the EU and in the UK than the US does at the moment.
Yeah. You talk about them doing the best that they can. I suppose that depends on the prism through which one is viewing a situation. Can our Reserve Bank do the best that it can, given our economic environment, our high unemployment environment? And, we're still behind the curve in terms of our inflation. We're not at 9%, 8%. We're just about 6%. What do you think the Reserve Bank is going to do, given what these leading economies are having to do with interest rates?
Well, let's just wait till some of the petrol increases come into play in the next few months and see how those numbers look again with regards to our inflation. Look, we're going to have to follow the US pretty closely. If we don't follow the US, what's going to happen is the market will punish us via the currency, and the currency will weaken. Then the things that we import will be more expensive. Then we'll have more inflation, and then we'll have to raise interest rates anyway. So we're going to have to follow the US pretty strongly. There's been countries that are bigger than us, better economies, stronger economies, better growth rates, and so on, that have tried to kind of buck this trend of, the market expects high interest rates and not doing it. Turkey is the best example of this. And the Turkish lira has weakened by, several, multiples of 100 over the last couple of years. I think they went from 3 in 2015 to 15, in the last year or so. So that's a massive weakening, and it's obviously caused huge trouble in the country. If we in South Africa try and buck the trend to say, okay, no, our unemployment rate is too high, our growth rate is too low, we can't really afford to raise interest rates, the rand will be punished, we'll have inflation, and we'll be forced to do it anyway. So we need to follow what the US is doing to basically maintain the kind of stability we have.
Viv, thank you very much. Always a pleasure talking to you. Thank you for your insights. Viv Govender is a portfolio manager at Rand Swiss.